Sage reporting for Kalkinemedia, and thanks very much for joining us yet again. Please stay watching, we have a trending news topic to follow. 3 easy ways to amp up your underperforming portfolio. You need not stress. We have some tips to share with you and hopefully these will take effect. After almost 14 months, the ASX 200 had rallied past the 7,000 mark on the 8th of April 21. The benchmark had been trading in a range of 6938 to 6517 since December last year. However, in the past few days, the market's buckled up and reached new highs since the pandemic hit the shores. However, the market's ascent in one direction does not necessarily mean that every investor's portfolio would also follow suit. A lot of portfolios might struggle to reach the green despite positive cues from the broader markets. There could be many reasons for this underperformance. However, this can be easily taken care of if one does some minor workarounds with their portfolio. So let's have a look at 3 simple tweaks an investor can make to counter his portfolio's underperformance. 1 is capitalise on corrections. The underlying principles of successful investing is to buy low and sell high. Every now and then, the market or stocks offer dips or a meaningful correction, which investors should capitalise on by adding to their existing positions or making new ones. Now, these relatively low-level purchases show their magic when the stock starts to rise again post-correction. The most common hindrance the investors face during a correction is the fear of falling further, which needs to be countered to deploy capital during these times. 2, avoid low-quality stocks. Sounds easier than it is, but hopefully with these tips you'll be able to do so. Most of the investors make a common mistake that virtually keeps their portfolio from delivering a meaningful gain. They buy low quality and fundamentally weak stocks or penny stocks in the hope of getting windfall profits. The primary reason for picking these scripts is their dirt cheap prices, and hence these can be bought in good quantity, leading to high gains if the stock rises. But most of the time this does not happen, and these low price stocks eventually show why they have been priced at these levels. 3 is portfolio optimisation. Portfolio optimisation could be a tricky subject altogether for most retail investors. It means to balance out the portfolio securities and allocations in such a way that it's optimised to meet an investor's financial goals. However, it could also be used via a basic common sense of an investor. For example, if a specific sector is gaining traction, then weightage towards those sector-specific stocks could be increased. Similarly, if a company is not delivering results as expected by an investor, then he may choose to reduce the quantity of that stock and add to the one delivering above expectations. And that is all for now. Thank you very much for your time watching, and hopefully these tips will be put to good use in your portfolio. This is Sage for Kalkinemedia.